Welcome to this video. Today we talk about common forms of guarantee, the forms and functions or the essential features of different forms of guarantee, their characteristics, how to choose the right solution for a specific situation, the primary distinction between independent guarantees and accessory guarantees. We will also look at other common types of guarantees like sureties or bank guarantee versus personal guarantee and corporate guarantee and standby LCs. We will go through the various safety nets in various forms for the global commerce that the guarantee instrument provides. Let us explore the functions. What are independent guarantees and what are accessory guarantees? Independent guarantees are standalone instruments that operate independently of the underlying contract. That is independent of the underlying contract. The underlying contract is between the buyer and seller, the applicant and beneficiary. The payment under an independent guarantee is triggered upon presentation of a compliant document, that is a demand or a claim, regardless of dispute over performance or non-performance of the underlying contract. So, the issues that you have on the underlying contract is independent of the right or duty on a claim under a guarantee. That is independent guarantee. So, what is a key characteristic? Autonomous. That is, it is not affected by the disputes. It is demand based. That means payments are made for a compliant demand without requiring a proof of default. Enforceability. That is, they are enforceable because of the independent nature of the non-related or non-association with the underlying transaction. What are accessory guarantees? Accessory guarantees are guarantees that are that are linked to the underlying contract. Now, if a bank guarantee is issued to secure a construction of a project, and it will ensure payment to the beneficiary if the contractor fails to meet the obligations. Even if the contractor disputes the claim, the payment will have to be made because it is an independent guarantee, it is issued by a bank. What are the advantages for an independent guarantee? Simplicity, clarity, legality, independence, and standard rules. These are the advantages of an independent guarantee. Accessory guarantee are those that are linked to the performance of underlying contract. They require a proof of default or proof of non-performance before payment can be made, which means there has to be a dispute. You will have to prove that there has been dispute. That evidence will have to be submitted. The proof that the dispute or non-performance or non-payment has to be evidenced and submitted along with the claim in case of an accessory guarantees in most of the cases. So, the example of an accessory guarantee could be in the form of what we can say, evidence that is conditional for the payment. Evidence that is conditional for the payment. Now, surety bonds. Surety bonds are a form of accessory guarantees because you have to demonstrate the contractor's failure to perform before you can claim under the surety. Personal guarantees are accessory guarantees because you have to prove that the person again in whose support you gave your guarantee failed to repay. Only then they can claim against you as a guarantor. So, what are the advantages of accessory guarantee? It aligns closely with the underlying contract and it is mostly used in domestic transaction where legal systems are well established. It normally applies for personal guarantees. Now, let us look at the independent practice. The applicant contracts with the beneficiary and approaches the bank to issue the guarantee. Guarantee is issued by the bank after being satisfied with the creditworthiness of the applicant. Then maybe the rules are as per URDG 758, the guarantee is issued. Then there is an underlying transaction, that is the guarantee which the buyer and seller, the applicant and beneficiary have already agreed upon, and that is supported by this guarantee. Now, when there is a demand, the beneficiary makes a compliant demand, and if it is in terms or satisfying the terms of the guarantee, payment will be made independent of what happens outside the guarantee. So, the multinational company can secure a performance guarantee from its bank to assure a foreign government that they will perform the contract awarded to them. So this is an independent bank guarantee. Looking at accessory guarantee, first a contract is formed between the buyer and seller. There is a primary agreement, and then they approach the guarantor saying there has to be a performance guarantee. So the performance guarantee of the bank will be backing the performance of the applicant. The performance period will be agreed, for example 5 years or 7 years, during which the contractual obligations are there, and then a default will be detected. Beneficiary identifies there is a default in performance, and then that has to be documented, and there has to be an evidence of breach of contractual terms. Beneficiary will claim along with this evidence that there is a default, there is a breach, and then the issuer will have to pay because the default or a breach has been documented and evidenced. So here there is a need to demonstrate the default before a claim can be lodged. So this creates additional steps, but it ensures that the claims are aligned with the actual performance or non-performance as per the underlying contract. Let us look at the sureties. What are sureties? Sureties are contractual agreements where a third party assumes the responsibility for the debtor's obligation. It is used in construction products, and they are mostly bound by the local laws and may involve completion of the work, not just payment. That is, surety may have to perform, not just pay for the losses. Bank guarantees, we know they are written commitments. It can be issued by bank, then it will be a bank guarantee. If it is issued by independent party, it will be an independent guarantee. It could be issued by institutions also. It could be issued by corporates also. If it is payable on demand, it will be called demand guarantee. And bank guarantees or demand guarantees are mostly used in trade finance and are governed by URDGs 158. The key difference is that in case of a surety bond, there is a responsibility or scope to complete the performance. So the issuing entity, the operating mechanism, they are all little different. Sureties involve performance, while the guarantees involve monetary compensation. But end of the day, both these, the surety and the guarantee, provide security. There is a small difference in the scope or the way they are performed, but they provide security. So understanding these distinctions helps us to decide which instrument to use for which situation. What are personal guarantees? Surety is a contractual agreement where a third party agrees the responsibility for the debtor's obligations, we have seen. Bank guarantee is a written commitment by a bank to pay a specified amount to a beneficiary if the applicant fails to fulfill their obligations, that we know. Personal guarantee is a guarantee where, like every guarantee, it is a commitment, but here the commitment is by an individual, not an institution, bank or a corporate. The commitment is by an individual, and they assume responsibility for another person's debt or obligation. Like a surety, here they are assuming a responsibility for another person's debt or obligation. So this is an unsecured risk. Guarantor's personal asset may be at risk. And then common uses are for small business loans or partnerships. The condition is that payment is contingent on debtor's default. Payment is contingent on debtor's default in case of a personal guarantee. Standbys. What are standbys? Standbys are guarantees issued mostly by banks, sometimes by corporates. They ensure payment to beneficiary if applicant fails to fulfill their obligations. So they are similar to independent guarantee. They are governed by UCP 600 or ISP 98. They are secondary payment mechanisms. That means they are not primary payment. Payment doesn't come from them. Payment will come from some other source. If that payment is failing, if that source is not paying, and if there is a breach, then there can be claim under standby. So when selecting a guarantee, a personal guarantee or a corporate guarantee or an individual guarantee or a surety, businesses must consider several factors to ensure the chosen instrument aligns with their needs and objectives. Now, personal guarantees rely on individuals' creditworthiness, corporate guarantees rely on the institution's creditworthiness, bank guarantees are more trustworthy because of their independent nature, irrevocable nature, transparent nature, and trustworthiness of the banks, because banks will pay because their reputations is at stake. So these instruments serve the important role of security, but they have little bit distinction in the way they conduct themselves in the guarantee ecosystem. Selecting the right guarantee is very important because it depends on the nature of the transaction. So international trade will call for independent guarantee or a standby because of the complexities. The relationship between the parties is important because some may favor accessory guarantee or a surety because of the mutual trust state, or because of the relationship they may benefit from enforceability of independent guarantee. Risk tolerance. Independent guarantees provide greater security. Accessory guarantees are having more flexibility. Regulatory requirement. In some jurisdiction, only bank guarantees or only demand guarantees or only independent guarantees are acceptable. In certain industries, there is a practice of taking certain types of guarantees. Now, if the guarantee is subject to UCP 600 standby or ISP 98 standby or URDG 758, then it is easy for everybody because of the standardization of the rules, the uniformity in the interpretation. Sometimes independent guarantees are simpler to execute, but they are more costly, while accessory guarantees are little less costly but a little bit more complex. So, the cost versus complexity, the requirements of a regulation or a standard rules to be applied, or the tolerance of how much risk you can take, or what's the type of transaction, or how deep is the relationship, these are some of the factors which helps us to decide what guarantees can be accepted for a specific situation. Now, why are guarantees comparatively independent guarantees preferred? Because independent guarantees are mostly demand guarantees. They are payable on demand. They are independent because underlying contract has no relevance to the guarantee. They are favored because they are simple. The text will be mostly subject to URDG or ISP 98. They are enforceable because mostly issued by the banks or similar financial institutions. So, one is clarity. Clear terms and conditions reduce the ambiguity. Second is speed. Payments are triggered upon complaint, demand or claim. There is no other reason for delay or dispute. Standardization, because they are recognized by ICC rules in the terms and definitions and interpretations. Trust, the strong assurance that is given to the beneficiary by the banks because it fosters confidence. So, expedited resolution or immediate payment, consistency across borders because of uniform rules, unambiguous terms because of the clear conditions and terms mentioned in the guarantee, and enhanced confidence because banks have a reputation of having paid the compliant claim swiftly. So, independent guarantees have a preference in international trade market because they address the core challenges in cross-border transaction. What are those challenges? Uncertainty, delay, ambiguity or trust deficit. So, by providing a clean or autonomous payment mechanism which is irrevocable, independent, payable on demand, unconditional, it will help not to have any dispute in the cross-border contracts. Let us look at a case study. If there is an European importer and an Asian supplier, then the importer evaluates the guarantee types for the machinery purchase because you have to pay for the machinery. Then you have to compare the alternatives, independent guarantee or accessory guarantee or whatever it is, personal guarantee, and then you decide you have to select the independent guarantee because of the simplicity and security for a given scenario. Because you are importing specialized machinery, the Asian manufacturer is looking for a performance assurance. So, the importer, after analyzing all the different types of guarantees, will have to make a choice which is simple, cost effective and payment will be easy, that is based on demand only without requiring any proof of default. Proof of default means what? The other party did not supply. How will you know the other party did not supply? There will be no proof if there is no supply. So, this will be complicated if you go to different legal systems. So, you need a URDG 758 type of situation. Different language, different jurisdictions, different legal interpretations. So, all that can be avoided if you have an demand guarantee, independent guarantee issued by a bank subject to URDG. So, this is how a decision will be aligned to the best practices. What are the key takeaways in this session? We need to understand the fundamentals of the guarantee, that is the differences between independent or accessory guarantee, how it is used in various financial requirements as a security, and then how they operate autonomously. Before deciding which guarantee to use, one has to evaluate the transaction specific requirement, cross-border elements, counterparty relationship, regulatory environment, risk tolerance, and this will give us an idea to select the most appropriate instrument. One has to implement the best practices by trying to adopt URDG or UCP 600 or ISP 98. One has to see how easy it will be to issue, monitor, and claim. One has to see how easy it will be to comply with the requirements of the guarantee from a regulatory angle. We need to also assess the performance against the transaction objectives from a cost and compliance angle. The market, the regulations, the best practices, all this evolve. And so one has to keep in mind the risk versus reward while deciding which guarantee will be best suiting for a given situation. So understanding guarantees is a requirement because it impacts the security of your transaction, efficiency of your contract, and cost of the overall end-to-end execution. Thanks for watching this video. We shall meet again in another session.